Hi, my name is Jin Choi and I'm the founder of MoneyGeek, and welcome to the 14th episode of this short course on investments. And today I want to answer a few common questions regarding saving money. The first common question I want to address is, how much should you save? And that answer depends entirely on your financial goals. If you want to retire with $1 million a year in income, obviously that will require a lot more savings than if you want to retire with $40,000 a year in income. I find that people generally have three major financial goals throughout their lifetime. And those are buying a house, saving up for your child's education, and perhaps most importantly, saving up for retirement. So let me talk about planning for retirement first, as a lot of what I'm going to say about planning for retirement can be applied to other goals as well. There are several ways that you can plan for your retirement. You can either hire a financial advisor, or you can do it all yourself, or you can try to use a retirement calculator. If you want a detailed and thorough financial plan, hiring a qualified financial advisor is the way to go. The trouble is that many financial advisors are actually just salesmen who try to sell you mutual funds and life insurance. So they'll either give you a poor financial plan or none at all. So if you want a financial advisor, I generally recommend that you go with a fee-only financial advisor. They do tend to cost a decent amount per hour, but you will get good value out of it. Another option is to try to plan your retirement on your own. The problem with this approach is that you have to be very comfortable with math and you have to be confident in your knowledge of investments. Otherwise, your retirement plan might be riddled with errors. The last method that you can use to plan for your retirement is to use retirement calculators. And you can find any number of free retirement calculators when you Google for them online. However, I do see a flaw in most of these calculators, and it's in how they assume that your investments will grow. Most retirement calculators assume that your investments will grow in a deterministic fashion. In other words, if you tell your calculator that you expect your investments to grow by 7% per year, then the calculator will simulate a future in which your investments will grow 7% per year, year after year. No more and no less than the 7%. However, this isn't how the real world works. Stocks may have returned 9% per year on average for the past 100 years, but the returns have been anything but smooth. In 2011, for example, Canadian stocks went down by 9%, and in 2012, the year after, it went up by 7%. If you plan for your retirement assuming that you'll get the exact same returns per year on your investments, then your retirement plan might fail if you get unlucky and your investments actually go down. That's why instead, I recommend using a retirement calculator that takes investment uncertainty into account. You can use these calculators to make sure that you'll have enough even if you're unlucky and if your investments don't perform as well as you expected it to. So where can you find such a calculator? I asked myself that exact same question, but I actually couldn't find one that I liked online. So I created one. The retirement calculator that takes investment uncertainty into account is currently available to MoneyGeek's paid members. So those are the options that you can pursue to plan for your retirement. And I can say substantially the same things when it comes to planning for your home purchase and when it comes to saving for your child's university education. In other words, you can either hire a financial advisor, or you can do it all yourself, or you can use a calculator. And just so you know, on MoneyGeek, there is a free tool that helps you plan for your home purchase. However, there isn't any tool currently that helps you plan for your child's education. But that might change if enough people ask me for such a tool. Now, let me talk about another common question regarding saving. When people start to save money, they often ask me if they should either pay down debt or start investing with those savings. And my answer to this question is, it depends on the debt. You can think about paying down debt as an investment, and that's because money saved is money earned. So if you pay down debt that has an interest rate of 5%, you're essentially making an investment that returns 5%. It's just that when you pay down debt, you're making a guaranteed rate of return of 5%. Whereas with most other investments, when you invest, you're generating an uncertain rate of return. Generally, interest rates on your debt are high enough so that it makes sense to pay down debt first. The only exceptions that I can think of are mortgages and low-interest student loans. If you have these, you could think about investing rather than paying down those debt. However, if you have higher interest debt, such as credit cards, then it's a no-brainer. You should pay down those debt first. Lastly, if you're struggling with budgeting and paying down debt, there are a lot of resources that you can turn to. For instance, I know that many people have found Dave Ramsey to be very helpful in this regard. And I know that a lot of Canadian personal finance blogs provide great resources to help you try to get out of debt. The only thing I want to caution you is that budgeting and investing are very different skills. So just because a site is very good at budgeting and helping you get out of debt, doesn't mean that they're good at investments. So I would like you to keep that in mind. And that's what I had to say about some of the questions regarding saving. So let me summarize what we learned today. We learned that most people generally have 3 big financial goals in their lives. And those are buying a house, financing their child's education, and financing their retirement. And how much you should save depends on each of these goals. There are 3 ways of creating savings plans for each of these goals. You can hire a financial advisor, or you can do it all yourself, or you can use a calculator. If you choose to use a calculator to plan for your retirement, I recommend using one like MoneyGeeks that take investment uncertainty into account. Lastly, in general, you should pay down debt before investing, unless that debt is a mortgage or a low-interest student loan. And that's all I have for today. In the next episode, I'll talk about which investments to hold and in which investment accounts. So thank you very much for watching, and I hope you have a great day.